Demystifying Bonds, an introduction to fixed income investments. Welcome to an educational journey into the world of bonds, a vital component of the financial landscape. In this video, we'll demystify the concept of bonds and equip you with a clear understanding of how they work, their different types, and why they play a crucial role in investment portfolios. So, let's dive in. The bond basics. At its core, a bond is a debt instrument issued by governments, municipalities, or corporations. When you invest in a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. How bonds work. Narrator, voiceover, let's break down the bond process. Imagine you purchase a $1,000 bond with a 5% annual interest rate and a 10-year maturity. Every year, you receive $50 in interest, and at the end of the 10 years, you get back your $1,000 investment. Types of bonds. There are various types of bonds, including government bonds, corporate bonds, municipal bonds, and more. Each type has unique characteristics, risk levels, and potential returns. Government bonds are generally considered lower risk due to the backing of the government, while corporate bonds carry more risk but often offer higher yields. Bond ratings. Bond ratings help assess the creditworthiness of bond issuers. Agencies like Moody's and Standard & Poor's assign ratings based on the issuer's financial stability and ability to make interest payments. Ratings range from AAA, highly stable, to D, in default. Yield and interest rates. Narrator, voiceover, yield is the return you earn from a bond, comprising both interest payments and potential capital gains. Bond prices and yields have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. Understanding this relationship is crucial for bond investors. Risks associated with bonds. While bonds are generally considered safer than stocks, they're not risk-free. Risks include interest rate risk, fluctuations in market interest rates affecting bond prices, credit risk, the issuer's ability to make payments, and inflation risk, eroding purchasing power over time. Role in investment portfolios. Narrator, voiceover, bonds play a vital role in diversified investment portfolios. They provide stability and income, acting as a buffer against the volatility of the stock market. A balanced mix of stocks and bonds can help investors achieve their financial goals while managing risk. Bond laddering strategy. Bond laddering is a strategy that involves owning bonds with staggered maturities. This approach provides a consistent stream of income while mitigating the impact of interest rate fluctuations. As bonds mature, you reinvest the proceeds in new bonds. Tax considerations. Narrator, voiceover, tax implications are another factor to consider when investing in bonds. Interest from certain bonds, like municipal bonds, may be exempt from federal taxes. Understanding the tax treatment of different bonds can help maximize your after-tax returns. Continuous learning. Bonds, like any investment, require ongoing education. Stay informed about market trends, interest rate movements, and economic indicators. Continuously learning about bonds will empower you to make better investment decisions. As we conclude our introduction to bonds, remember that they're a crucial tool for investors seeking stability, income, and diversification. By understanding the basics, exploring different types, and considering their role in your investment strategy, you're on the path to harnessing the potential of fixed income investments. Thank you for joining us today on this journey through the world of bonds. Knowledge is your ally in the realm of investments. If you found this video informative, be sure to like, subscribe, and share it with fellow learners seeking financial understanding. Until next time, may your investments be both secure and informed.